Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
The underlying exchange rate at expiration, we're going to settle, options are going to settle into either zero or the difference between the exchange rate value, the ISE pair value, less the strike price, or that's for a call or a put, depending on if it's a call or a put. So for instance, if I buy the 100 call and the pair value settles at 105, well, if I'm still long that call, I'm going to receive about 5 points times, of course, 100 or $500 every contract that I have. If I had a put option, though, let's say that I had 100 put and it closes at 105, well, that option would settle worth less. If I bought a 110 put and it settled at 105, that option would settle at 5. So the underlying exchange rate is very, very important relative to the strike price. The greater the likelihood of the option expiring in the money, the greater the delta. And I'm going to get more to delta in just a brief moment. Strike price, we can select different strike prices. I like to say that strike prices can be categorized into 3 different broad categories: in the money, at the money, and out of the money. So that's essentially what you can, you might want to look at strike prices in that way, that if you're looking at the U.S. dollar Canadian and it's trading around 104, your first stop, at least in my humble opinion, might be the at-the-money option. If you want more leverage and it's a call, you might want to look from, let's say, the 104, move up to the 107, 108, 109, whatever. Or if you're looking at puts, you might want to look at 104 as the at-the-money option and go down to 101 or even 99, 98. Those are out-of-the-money options. So that is the way that you can manage your risk-reward proposition, your ratio of risk to reward. Time. How does time affect an option? Well, time is not linear. So really what I'm saying is that short-dated options are going to decay a lot more, like somewhere in here. Longer-dated options are going to hardly decay. You look at the slope of the line of a longer-dated, let's say this is a 9-month option versus a 1-month option. This one's hardly decaying at all, basically flat. It's very steep here. So that's called, well, the Greek term for that is theta. Generally, the greater the time decay, the greater potential for rapidly changing delta, and that's called gamma. Gamma manufactures delta. So there's this relationship between theta and gamma. If you buy an at-the-money option, you're going to get a lot of gamma. But the disadvantage of buying that gamma is that you're getting an option that's decaying a certain amount each day. In fact, it's going to be even higher. The at-the-money options are going to decay even more. As I mentioned, options have value for 2 reasons: the interest rate differential and volatility. I guess I didn't mention that, but this is a very important factor. If interest rates were 0 and if volatility was 0, all options would trade at either 0 or their intrinsic value. In reality, we know that doesn't exist. Interest rates are going to be a little bit greater than 0. And volatility will ebb and flow from very, very low levels. When we first introduced the FX options, some of the currency pairs were trading as low as 5 and 6 volatility. Well, a year or 2 later, the volatility went from 5 and 6 all the way up into the 30s and 40s. So volatility can and will change. So the Greeks, how does all that apply to the Greeks? Well, the major difference between equity options and FX options is the interest rate differential. And you need to always, always, always think about volatility. And I showed you how important volatility is when I looked at that option that was, let's say, a 60-cent option and with volatility low, and with higher volatility, it might be worth $1.60. More uncertainty, higher volatility. Less uncertainty, lower volatility. Option Greeks are analogous to risk gauges in a car that alert drivers of the various risks of the car's engine. We're driving down a highway. Of course, we're thinking about the temperature light goes on, the battery light goes on, the oil light goes on. If you continue to drive your car, you're going to have a problem. Well, when you're trading options, you need to understand the Greek risks, because the Greek risks are going to help you understand if you have a lot of delta. If you have, again, everything in life is relative. So what is a lot of delta? What is a lot of theta? What is a lot of vega? That is something that you're going to have to get used to. I can't tell you. I can't quantify a certain amount that is either too much or too little. But you'll start to understand that the Greeks are important. And as I mentioned, and a lot of you you guys answered my question about which Greek might you start to consider that might be the first stop for learning more about the Greeks. Delta is going to be your first stop. And really what the delta is telling you is if the underlying exchange rate moves a point, how much is my option going to move? So that exchange rate changes, that would be delta. The time erosion of your option is going to be what's called theta. So we have delta, and we have theta, and then we have gamma, which, as I mentioned, is giving me my change in delta. And really, gaps are most affected by the gamma because delta might change. You might see an option that's at the money or even out of the money, and if it turns to be in the money, that would mean that delta would pick up, or if it's going the other way, it would actually be reduced significantly. Changes in implied volatility, vega, and changes in the interest rate differential, rho. So let's just go through the Greeks once again. Delta, quantified from numbers 0 through 1 or 100. You can look at it from decimals if you'd like. It really just depends. If you like to use whole numbers, you might want to say anywhere from 0 to 100. Otherwise, decimals, anywhere from 0.01, if you will, or even 0. Really, an option, you don't really see options that have 0 delta. They usually have 0.01, even though that option might not even be moving that first couple points. So you see a delta to be very, very low all the way up to very, very high. So let's just call it 0.01 all the way to 0.99 or 0 to 1. So a deep in the money option is going to have a delta that's going to be pretty close to 1. It's going to move, some would say it has a very, 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 very tight correlation with that exchange rate value. One that has an extremely loose relationship would be an out of the money options, and that's how you would really define delta. Gamma is going to tell me how quickly my delta is changing. So gamma is going to manufacture a delta. So if I had a delta of 52 and a gamma of 7, and the underlier, the exchange rate moved up a whole point, I would actually take my old delta 52, add it to that previous gamma of 7, come up with my new delta of 59. Remember, delta will not stay constant. It's always changing. I need to think about what is my gamma.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.